I'm Kanchana Tilakaratne, and on behalf of the School of Computer Science and the BAS organizing team that includes Sasa Rubin and Barbara Stephen, I would like to welcome you all to our BAS seminar today, and which is the School of Computer Science, the research seminar series. And for those who joined first time to one of the BAS seminars, so allow me a few words about the BAS seminar series. So it is named after Sir Adolf Brasser in recognition of his donation that helped to build the university's first computer in 1956. And then, which for sometimes it was called the brain, and then for some times, and the graduates from our school is called BASA graduates as well. With that, so we have, very special presenter today. So let me introduce Dr. Solon Barocas. So he is a principal researcher in the New York City lab at Microsoft Research. And he's also an adjunct assistant professor in the Department of Computer Science at Cornell University. He completed his studies, doctorate at New York University, and then went on doing postdocs at Microsoft and Princeton. So his research explores ethical and privacy issues in artificial intelligence and machine learning, which is a very hot area these days. And he also co-founded the workshop on fairness, accountability, and transparency in machine learning. So without any further ado, let me hand over the mic to Solon. Okay, so I forgot to mention one thing. So Solon would like you to ask questions at any time. So I believe all of you are now very familiar with Zoom functionalities. So please raise your hand, your virtual hand, so we can take questions any time. But if not, we have more time at the end to have interactive discussions and more questions. Solon, so the floor is yours.
Thanks so much, and thank you for the kind introduction, Kanchana. It's really a pleasure to be here, and I appreciate everyone coming, what I take to be an early morning meeting. I also want to just thank Joseph, who actually was the person who reached out to me originally to invite me to join you. And I understand he's not feeling well, but I'm very grateful for the invitation. So I'll be presenting some work today, which is broadly in the area of explanation, which is also another hot area among those topics that sort of have this ethical valence in the area of machine learning. So the past decade, there's been a lot more work on this topic. I should say at the outset that I'm actually not a computer scientist myself. I have a kind of odd background. I've done a lot of work mostly on sort of philosophical and policy questions related to machine learning. And so what I'll present today is not terribly technical. There'll be some small technical details further into the talk, but it'll be a fair amount of text on the slide. So I hope you'll bear with me. And I should just emphasize again that this is work in progress. So this is not a published paper. This is work that I've been doing with Manish Raghavan, who was previously a doctoral student in computer science at Cornell, and is now a postdoc at Harvard. And he and I are in the middle of working on this paper. So we very much welcome any feedback. So interruptions while I'm presenting are more than welcome. And I'm very happy to kind of hear any questions or even to have you folks challenge some of the claims I'm making. So please feel free to interrupt and raise your hand. I have a little window open here where I should be able to see if you raise your hand. Okay, so with that, let me jump into things. The presentation is titled Explanation in Whose Interests? And what Manish and I are trying to get at in this project is to kind of look at the fact that different styles of explanation can advance the interest of the party who is providing the explanation or the party that is receiving it. And there hasn't been that much attention paid to the fact that these differences, especially in the context of some high stakes decision making, really do matter. So the area that we're particularly interested in is finance, consumer finance, in part because it's one of the kind of common motivating settings for a lot of the work that's been done over the past decade on the need for explanations in machine learning-based decision-making. And as I'll explain in a moment, it's also an area where there's existing law that actually requires explanations. But despite the fact that this is a really common motivation for a lot of this work, the work tends to adopt a pretty stylized view of finance. And by that, what we mean is that it often presents the decision that lenders are making as binary decisions, where they're simply deciding whether to lend or not. But in practice, what we actually observe is that these kinds of models are often used instead to sort of estimate consumers' risk of default, but not necessarily to just, in a binary fashion, classify them as creditworthy or not. And these estimates of risk of default are actually used to inform a more nuanced, more complex decision, which includes setting a number of terms of the loan, again, not just choosing whether or not to loan. So for anyone who's had experience getting a mortgage, you will know that there are many different terms that come along with securing a mortgage, including differences in things like your interest rate or the down payment you have to pay, or even the schedule, the kind of time horizon over which you will have to repay a loan. Again, in practice, what lenders are doing are not making decisions about just whether or not to give a mortgage. They're making these more complex decisions on the exact terms that they're going to be providing a mortgage. And this is not well accounted for in pretty much any of the work that's been going on for the past couple of years, which again uses finances as kind of very common motivation. Okay, so why are we so concerned about this? Why is it such a big deal? Well, there's a magazine in the United States called Consumer Reports. It's a monthly magazine that's actually put out by a consumer advocacy organization that essentially writes stories to help everyday consumers better understand how to navigate, the market, how to make sensible purchases. It's a very popular magazine when people are trying to figure out what car to buy. But they also do some investigative reporting. And just last year, they wrote a very interesting story that actually looked at the terms that people were paying when they secured a car loan. So this is a loan specifically for buying a car. And what the story basically shows is that there aren't that severe a disparity between which groups are able to gain access to car loans, meaning, for example, minority applicants are obtaining loans at a roughly similar rates as others, but there are pretty profound differences in the terms on which different groups are obtaining those loans, right? So it may turn out that the interest rates that some people are paying are much higher than others. And in particular, what this piece did using some clever design, research design, was basically find out that even people who have the same credit scores end up actually paying sometimes quite different interest rates, which is a signal that the amount that you're being charged is not really directly proportional to your underlying risk, but instead is in some ways a reflection of what the lender thinks your willingness to pay is, how much they can charge you that you would tolerate. And so what this kind of suggests, again, is that there is quite a bit of variability here that might be missed if we're just only looking at access alone. And so these omitted details can be very consequential. As I was just saying, they can really conceal the fact that while access might be similar, the terms on which you're gaining access could be quite different. This might be the same, for example, in employment, and I might even circle back to employment later, where maybe there are similar hiring rates between different groups. But if you look at the salaries that people are being paid or the jobs that they actually get in those particular companies, there can be pretty serious differences, right? So these terms actually matter quite a lot. And in the context of lending, the terms also really matter in terms of whose utility is being advanced, right? So how much the consumer benefits or how much the lender benefits really depends ultimately on these differences in terms. And I think critically, and this is, I think, one of the issues that regulators really care about, is that access on especially unfavorable terms can be actively harmful to consumers, in part because they might default, and in part because default will have long-term impacts, as I'll explain, on consumers' ability to secure more loans in the future. And this might be true even if it ends up being that that loan was profitable for the lender. Okay. So as I mentioned, there are some legal obligations, and I should just say at the outset here that this talk is very US focused. I'm based in the US. The laws that I'm referencing here are specific to the US. I actually don't know if there are equivalent laws in Australia, although I'd be very interested to hear. I'll mention the GDPR at some point, but again, for the most part, the context I'm thinking of here is the US. And in the US, there's actually a law called the Equal Credit Opportunity Act, which requires that lenders provide consumers with explanations for any adverse decision they might make. This law is actually the anti-discrimination law in the United States. It's the law that prohibits lenders from discriminating against people on the basis of gender or race. But notably, unlike other discrimination laws in the US, it has this explanation requirement. And so if you ever apply for a loan and are rejected, the lender actually needs to provide you with an explanation. And what is interesting here, and this is only something that Manish and I really recently discovered, is that what constitutes an adverse action from the point of view of the law is not just a rejection, but actually a refusal, I'll quote here, a refusal to grant credit in substantially the amount or on substantially the terms requested in an application. So this is somewhat surprising, because what this is really saying is that even if your application is successful, if it's perhaps less favorable in the terms of the offer than you might have wanted, you're still entitled to an explanation. So this is surprising. I think most of the work that's been done, even my own thinking on the topic, had been premised on the idea that only rejections triggered this requirement. But the law actually says that it's an adverse decision if it's less favorable than it otherwise would have been. So this is kind of the legal context in which we're thinking about this. And maybe I'll just give a little bit more background on this adverse action notice requirement, because I think it helps maybe it would be helpful for me to contextualize this legal requirement in the context of the existing work that's been going on around explanation of machine learning. So let me say a bit more about this. If people have been following this discussion at all, it really kind of exploded. The literature, the scholarship on this topic exploded a couple years before the European Union's General Data Protection Regulation was supposed to come into force, because there was perceived to be this new legal requirement that amounted to a right to explanation. There's been a significant amount of debate about that right. I won't get into it now, but what was somewhat surprising to the American audience that was following this debate was that there was actually an equivalent law in the United States, as I just referenced, that's been around for more than 40 years now. So I mentioned the Equal Credit Opportunity Act, but there's a number of other accompanying laws, the Fair Credit Reporting Act and Regulation B. The Fair Credit Reporting Act is essentially a privacy law that's oriented around consumer data for lending. And Regulation B is sort of the regulator's stipulation of how those laws will be interpreted. And all these documents independently have their own explanation requirements. And specifically, what the law says in ECOA anyway, is that when you have one of these adverse decisions, the lender must explain, and specifically, quote, no factor that was a principal reason for adverse action may be excluded from disclosure, and the creditor must disclose the actual reasons for denial. And interestingly, the law also says that no more than 4 specific reasons are likely to be helpful. So, again, this law is quite old. It was developed in the 70s. This requirement has a long history, but it actually, all the way back then, was encouraging a degree of sparsity, right? We want explanations that are not exhaustive. We want these sparse explanations that focus specifically on factors that really matter. So this is the legal requirement. And interestingly, the regulator here in the United States, the Consumer Financial Protection Bureau, that has authority for enforcing this law, has for the past 5 years been quite concerned with what the introduction of machine learning into lending might mean for this legal requirement. So there's been a lot of concern about, like, are machine learning models inscrutable? Is it impossible for us to apply this law now that we maybe don't even know how these models work? So the quote I have here comes from a request for information. This is a formal mechanism that the agency relies on to elicit information from experts and from the public about these questions that they're trying to tackle. And you'll see here that there's just some concerns here about whether or not some of these novel approaches that come mostly from machine learning are compatible with this requirement. They actually received a ton of feedback to that request in 2017, didn't do anything with it as far as I can tell. There was no public report. And actually, a couple of years ago, they had yet another round of requests for information expressing similar concerns, right? So still in 2020, worries about whether or not it's possible to have compliance when you have these new models. And they've, again, collected a ton of interesting comments from the public and from experts. Finally, my impression is that there's a kind of joint effort between this regulator and a number of others in the United States to kind of come to some consensus about giving guidance on this. And so I imagine in the next year or two, there will actually be some statement by the regulators about how they interpret this law in the context of something like machine learning. But what's quite interesting about all this, oops, what's going on here? Okay, sorry, my advanced. Okay, great. Sorry, so for some reason that was not working. The slide you see is when weakness is a strength. Is that right? I think. Okay, great. I'm assuming so. Okay. So what's interesting about these requirements, though, is that they don't require that the lender explain why or how any disclosed factor might have affected the decision. Right. So they just say, actually, this is a shame. Sorry. I think what's not working is an example of an adverse action notice. Give me one moment. Let me see if I can actually bring it up. Okay. Do people see this at least?
Yeah,
yes.
we can get.
Okay, great. Sorry, that was the trouble. For some reason, it wasn't rendering on my screen. Okay, great. Okay, so to give you an example of what this looks like, when I had previously given talks on this topic, I used to ask people, especially when I was giving talks in the US, who has ever received one of these notices? And then what I quickly discovered is that like no one wants to volunteer to tell you that they've received one of these because it's, you know, this kind of like adverse event. No one wants to say like I applied for credit and was rejected. And so I actually have an example of my own, which was somewhat kind of strange. So I went one day to the store to ask about getting a new cell phone from my cell phone provider. And without my knowledge, apparently, that company, while I was in the store, ran some process to determine whether I like qualified for some promotion. And based on its own, you know, scheme for deciding who qualifies, I was determined not to be a good candidate for this promotion. Okay, I had no idea this happened. Many weeks later, I got a piece of mail, like a snail mail, and I opened it up and I had this notice. And so this is actually what these adverse action notices look like in the United States. This is, I think, fascinating for many reasons, and I won't belabor it. But what you see here is that they have, if you can see my cursor, they have, you know, a couple of specific things that are pointed out as being these like marks against me. But notice how incredibly vague they are, right? So like account history, length of service. Some of the stranger things are voice usage patterns and payment history and so on. So this is the level at which these notices tend to appear. And yes, Clement, is that your name? Sorry, please go ahead.
Yeah, I've got a question about the law because as phrased, if there is no auditing or like no opening the black box kind of thing, what, like as the example shows, what prevents any company to say, like to just output the first feature, what, even if it's not relevant, and just say like that was the reason and end of story?
Good question. I talked to the regulator about this. Like they have, they've collected many examples of these notices. When they take an enforcement action against like one of these lenders, they'll often have access to a lot of the things they issued. But as far as I know, like there hasn't been an attempt to like go and test whether the stated reasons for any particular adverse action match the real reason. But what I'll get at in just a moment is, let me see if I can get there. Yeah, so I'll jump ahead a tiny bit, but you'll see at the very bottom of here of this slide, the agency is like almost now, like in a way that's almost, I think, unproductive, very, very focused on the accuracy of the explanation. I mean, they want it to be the real reason why someone was rejected, because I think they have a worry that like it's going to be made up or maybe it's misleading. They don't quite recognize, which is the point I'll make in the slide above this, that there are many possible ways to explain an outcome, all of which are strictly accurate, but they can be done in very different ways, right? So there's no one particular way to explain a machine learning model's decisions. We have obviously now many different methods. In some sense, all of them might be accurate, but they can emphasize different things. And so the agency is largely focused on accuracy, has not really thought about the fact that different styles of explanation might be more or less useful. But I agree, Clement, that you know, there really isn't any guarantee that these things are what they are, what they say they are. but the law at least requires it to be like, so here the text actually says, like it has to be the actual reasons. So long as people are following the law, that's supposed to be what's happening. Okay, let me, oh, sure, next, yeah, please go ahead.
Hi, just a quick question. So how do the consumers, I guess the bottom sort of the, so my question is really, have you guys looked into how consumers actually understand their rights, right? So if I'm a consumer and going to AT&T or T-Mobile and I got a phone and they said you don't qualify for the promotion, I'll be like, okay, that's the end of the story. So who gave consumers the tools and approaches to proceed these kind of claims? And then, I mean, to get a cell phone is a small thing. What about house loan, mortgage, and car loans? And I sort of wonder about these questions. At the end of the day, is whether or not they have the means to approach through this problem, and then if not, they're probably going to go pursue some other ways, which is one of those high interest loaners. Thank you.
Yeah, this is also a very good question. So part of what's happened, at least in I'll answer this in two ways. The first is that, as far as I know, there's been no empirical study of the value of these explanations. So like, though it's been a requirement for decades, and though the agency is obviously very committed to trying to enforce it and possibly do a good job, there hasn't been a study to show that this actually benefits consumers in some obvious way. So that's one, and I have a lot of thoughts on that. The other thing, though, is that like these notices are required. So like, if there is some adverse event, you will receive one of these. The question is like, what do you actually do with this? And a lot of the technical research that's happened over the past decade has been oriented around that question. So this feels very unhelpful, right? It's sort of like, I have no idea what to do with this. Like, I can see this and I can maybe feel like resigned to my fate because I accept that like maybe there's some reason they have, but I had no idea what to do about it. And again, I'll jump ahead a little bit here. The strand of research that has been particularly popular over the past couple of years is what has been known as counterfactual explanations. So the formulation, the problem there is pretty simple. It sort of says, what is the kind of minimal change that someone might make in their input features that, if those changes were made, would result in the positive classification, right? So like, what is the minimum change I can make to get to the other side of the boundary? That's basically the way the problem is formulated. And so this work is sort of an answer to your question, right? Like, if the purpose of these things is to help consumers obtain the loan, this seems like a quite reasonable way to formulate the problem. And frankly, I think counterfactual explanations not only have been technically successful, but I think it's been very persuasive for a lot of policymakers too. So one thing that might end up happening is that in the United States, they might end up saying, though the law doesn't require counterfactual explanations, we would encourage lenders to adopt them, right? So this is, I think, one possible direction. Does that answer your question?
Yes, thank you. Just if in the later part of your presentation, you can talk about this one minor thing, kind of bothers me a little bit, is the fact that individuals do not have a larger demographic data to reflect the claim. So let's say, I'm reporting my case, but I really don't know how many other people in what kind of degree. And then to the Consumer Bureau, the companies are not obligated to disclose their model. So what are the ways that this can come to an end for like beneficial to consumers? Thank you.
Yeah, that's a great question. I'll answer it pretty quickly so I don't get too bogged down here. But in prior work and some legal scholarship I've done with other colleagues, we look at the history of this requirement, and it was clear that because, as I mentioned, it actually comes originally from an anti-discrimination law, the thinking was that the explanation requirement would help reveal discrimination. And I think that's just wrong, right? Like, when I receive an individual explanation for only my adverse outcome, there's no way for me to really identify systematic differences in the way the model might be treating different groups. That's just not really possible. So this was like the kind of naive hope. I think in practice, regulators, for the most part, have settled on the idea that it's mostly a mechanism to help consumers navigate the process of obtaining credit, which is different than trying to reveal discrimination. And separately, again, like there's been a lot of research, mostly from a group out of Harvard, showing that all sorts of nefarious model behavior can be concealed and in a way that like the explanation would not reveal. So I think I agree. If the concern here is to reveal unfairness in the model, explanations from my perspective are pretty unhelpful.
Thank you very much.
Okay, let me just maybe get through these slides quickly. Right, and I'll share my screen again. Okay. Oh, I just lost some. Give me one more second. I apologize. Okay, great. Yeah, I think I've made these points right. Right. Okay. So as I was saying, I'll just repeat this maybe quickly. The law gives a lot of latitude to lenders. There's not like this very precise requirement about how to actually give explanations. And I think this is largely due to the fact that there's just no one particular way to figure out how to specify what counts as principal reasons. So I was mentioning counterfactual explanations, but what's interesting is that counterfactual explanations are quite different than what was the recommended method by which lenders were supposed to actually figure out principal reasons. So Regulation B actually gives examples of the methods that lenders could use if they wanted to figure out what to report as the principal reason for an adverse action. And I'll just read them because they're actually quite bizarre. So the first method they propose is to identify the factors for which the applicant's score fell furthest below the average score for each of those factors achieved by applicants whose total score was at or slightly above the minimum passing score. So that's a mouthful, but what it's basically saying is like, look, take your population of people who you've lent to, you've previously like actually offered loans. Look at what the average was for each feature value, and then compare the applicant that you rejected to the average of that feature value across all features, and then report those where the gap is the largest. That's basically the method. The second method they propose is even more bizarre. It says, use not the population that you actually were granting loans to in the past. It says just use the entire population. So in a way, it's almost like the opposite of counterfactual explanations, right? Counterfactual explanations sort of saying, here's this change that you could make that would be smallest that would get you over the boundary. The methods that they were proposing was something like, here's the feature along which you're somehow most deficient, if that makes sense. So it's a very odd way of thinking about it, but from the agency's perspective, and maybe from the people who are drafting this law, I guess it was seen as a way of like having certainty that like this was the real thing that dragged you down. But as I was saying, I think there's a real interest in trying to move away from this, which feels like much less helpful to something like counterfactual explanations. Okay. Oops. Right. Okay. So here's the thing, and now I'll come back to the main topic of the talk, which is that counterfactual explanations are kind of interesting because they treat access as like the exclusive thing that matters here, right? Like all we care about is getting to the other side of the boundary. The whole point is to like figure out the easiest way to get there, as if access is all that matters. And what I'll try to explain is that like in the context of credit, obviously access is not an unmitigated good. There can be many circumstances where gaining access can be harmful, or it could be less, favorable to consumers than it is to the lender. So to begin with, it's clear that, access can impose really serious costs on consumers. So if people default, they can be subject to all sorts of penalties. I mentioned earlier that it might be a mark against you in a credit report, or it might make it difficult to gain access to credit in the future. There's been some work done by colleagues at Berkeley showing the kind of long-term effects when you have this kind of process where people might default and then over many generations, like not be able to access credit in the future. But in other cases, like we have secured loans, which you actually have collateral for. And so you can actually have property seized. So for example, when you default on a mortgage, the lender repossesses the property, despite the fact that maybe you've paid a lot already toward that mortgage, okay? So these are not just about future access. This can be like real material goods of considerable value. So obviously, default is not a good thing for consumers. But of course, default in some sense is also not good for lenders. Oh, yes, Joseph, please.
Yeah, thanks for that. Yeah, we've seen from the financial crisis that access is not the issue. It's certainly at certain times in history. Access can be very problematic, as you've seen then. But my question is, banks obviously very often glad to hand out money especially when they're flush with funds and so on. My question is, are you suggesting that they're running two algorithms, one to really do the access, which may be not very rigorous, and then they're running another one to decide on terms like, interest rate and various other terms and conditions? Is that what they're doing? If that's the case, then regulatory agencies are going after the wrong cost. Then is that the situation?
Yeah. So my understanding, and I've been talking to some folks both in industry and a number of advocates here in the US who are focused on lending, and that is my impression that there's two different models. So there's one that is what they call an underwriting model, which I think is trying to predict default. Like the target of the prediction is default. But there's a separate model, which is actually not even like a statistical model. I think it's a financial model, which is essentially trying to figure out how to optimize the terms of the loan to maximize profit. And that these are used in combination.
Yeah, thanks.
Okay, and that will become a bit more relevant as I go on. But generally speaking, I think you're right. This law, as I've been reviewing it, is very much targeted in some sense to the idea that there's that these are one and the same, but clearly they're not. And for the most part, it's been somewhat concerning to see that there's sort of expectation that the decision that needs to be explained is the default prediction, when in fact, it's often the terms that we might care about. Okay, but let me carry on here. So I was about to say that obviously default and these kinds of things can be costly for the lender as well, right? So if suddenly the lender incurs many defaults, as we saw in 2008, there'll be either a need to accept some amount of losses, or maybe they actually have to spend a lot of money to try to track people down and really get them to pay what they owe. So this is not trivial for them as well. I think what's maybe important to recognize, though, is that those costs are going to be passed on to consumers in most cases. So rather than sort of accepting those losses, I think what will end up happening in most cases is that the lender will begin to raise interest rates, or maybe they impose stricter requirements on lending, or maybe both. And I think in turn, what that often then will mean is that the people who were previously kind of closest to the decision boundary, who are potentially most cost sensitive, are going to be the ones that are hurt, right? So as default rates go up, there are actual other consumers that are going to be harmed by this because the cost of access is going up. And so, it's worth kind of reflecting for a moment on the normative value of simply having less expensive access, right? So in keeping prices down and making interest rates lower, lenders are in some sense actually increasing access to credit. They're making it cheaper for people to get credit. This is a different intervention than a lot of the interventions that people who've been working on fairness in machine learning have thought about. Again, there, the focus is on just binary decision, lend, don't lend. So the interventions in those cases tends to be, can we equalize lending rates? And that might increase access for some groups, but it could also have this effect of maybe increasing costs, which will have then this secondary effect of maybe pushing some other people out of the market. So if your goal is to increase access to credit, it's not so obvious that the best way of doing that is to simply begin to loan to people who might actually end up defaulting. We might actually think that one way of doing that is to really try to figure out how to keep the cost low. And in fact, if you talk to regulators, or if you even read the legal scholarship on these topics, this actually is one of the main things that they're concerned with. It's not access in general. They're often trying to think about how to keep the cost of access relatively low too. Okay, but I don't want to kid ourselves here, right? What I've just presented made it almost seem that there's alignment between the interests of consumers and the lenders. But for reasons I was saying earlier in the talk, lender welfare and consumer welfare can really diverge depending on the terms of the loan, okay? So, this is really not a win-win situation in many cases. It might sound nice to be able to find qualified candidates and to lend to them, but it's very clear that different arrangements will favor one party more than another. And the whole idea of predatory usurious loans is a good example of that, right? We recognize that there might be some terms that consumers are willing to accept that are just predatory, right? That are incredibly difficult for the consumer to pay, or maybe they're able to pay them, but are incredibly unfavorable to them, or usurous loans where it sort of locks people into this kind of repayment in perpetuity, right? And I think if you take this view, you begin to recognize that the ideal candidate for something like a credit card is not what you might expect, right? Like in the machine learning literature, you might think the ideal candidate is someone like this first bullet point, right? It's like the person who pays their balance in full each month without exception, right? Like that seemingly would be the perfect person to lend to, right? If the whole point is to avoid defaults. But that's not what they're trying to maximize here, right? Instead, it's something like this. It's like someone who carries a large balance, only makes the minimum payment, tolerates a high interest rate, maybe even misses payments and racks up fees, and does this in perpetuity, right? Like that's actually what the bank is looking for, like a reliable person who is going to be extremely lucrative. And that's very different than what I was just saying. And this begins to highlight that there just really are differences in the way the terms will benefit these two actors. And we can begin to think about this across a number of different dimensions, right? So part of it is that, as I'll say, there's differences in the view of the value of immediate access to money, differences in the view of default, and finally interest rates. And I'll say this, I'll go through this pretty quickly. So to begin with, right, there's just different views about why access to money is even valuable. For consumers, right, the whole point of a loan is that access to money now is more valuable than access to money in the future. And as a consequence, they're going to be willing to pay a considerable amount of money for that privilege, okay? But lenders are sort of the opposite position. Like they don't need to sit on cash. They just need to have kind of steady cash streams. And so it's perfectly fine to have a lot of money spread out over time, so long as they're able to recoup that in a kind of predictable way, okay? Sorry, I don't know why this is not working. Okay. Sorry about that. Right. And this continues with defaults, right? As I said, like lenders might prefer to avoid default, but it's not catastrophic, right? So the current approach to lending in many cases is not to minimize risk, it's to manage risk. It's to figure out how to make the most money given the risk. And so in many cases, it's sufficient for lenders to simply recoup the principal, meaning the full amount that they actually lent out, and draw some profit, even if the loan results in default, okay? Whereas this is sort of the opposite, right? Like default is very expensive for the reasons I was saying earlier. And finally, interest rates. Okay, so interest rates are interesting because they are used as a mechanism to offset risk, right? So if you think of actuarially fair pricing, the idea here is that we're going to set the interest rate sort of proportional to the underlying risk to make sure that if some fraction of people default, we've at least collected enough money to cover those losses. But interest rates are not just a mechanism to offset risk, they're also the mechanism that lenders use to make profit, right? So they're trying to charge some amount above what is strictly necessary given the actually fair price. And as I was saying, because there's a lot of value to gain access to money now rather than the future for the consumer, they might be willing to spend a lot of money for that privilege. But here's the thing that's interesting. I think, like, as I was saying at the earlier part of the presentation with this report from this article from Consumer Reports, in many cases, interest rates reflect not just the underlying risk, but instead this kind of willingness to pay, how much the consumer is willing to tolerate. And the difference between what the consumer is willing to pay and how much the lender would have been willing to offer is known as the surplus in economics. And so as the lender is able to kind of better figure out the highest amount that the consumer is willing to tolerate, the more of that surplus is going to the lender. Okay. And again, these are like, I mean, you could think of that movement between the lowest amount that the lender is willing to offer and the highest amount that the consumer is willing to accept. Like the way we vary that term is exactly proportional to differences in utility. I'll skip this point for now. This is probably a little too much. Okay, let's see. Okay, right. So now let me do a little bit more to make this concrete in the context of explanations. I kind of given you this very high level point about differences in utility. What does this really mean in the context of explanation? Okay, so I think one immediate thing you can point out, and in some previous work we were looking at this, is that if you adopt this counterfactual explanation approach, your goal is to find the easiest thing that people can do to get across the boundary. This is not going to be very robust because in many ways, that's the place where it's easiest for anything to go wrong, right? So if the feature values of other things that matter to the decision change while you're making the changes that have been suggested by this counterfactual explanation, then you might still find that you're not on the other side of the boundary. Or maybe, you just get across the boundary, but like you're still at incredibly high risk of default because you haven't really made yourself much better equipped to, to kind of bear this loan. And so from this perspective alone, you might be very concerned about the robustness of this explanation. You want to make sure that like when we tell people to do something, that if they do it, they're going to somehow be safe. But what does that really mean? Like, what does robustness really mean in this context? And I think what it really means is that like people can have quite different preferences over different things. So if all you cared about is access, you might say like, yeah, great, tell me the easiest thing to do because all I want to do is gain access. But what if you also care about the risk of default, which is what this is kind of getting at, then you might say like, well, no, actually the explanation I want isn't just the easiest thing. It's the thing that I can do that's easy, but also minimizes my risk of possibly defaulting. And because that's not what's actually being predicted, these are not the same thing. And so we can make this a bit more concrete again in the context of explanation. So like this plot is trying to show something pretty simple. So on the x-axis, we just have risk, and on the y-axis is your interest rate. And so if you look at this region that's depicting what would be kind of an acceptable area in which to loan for the lender, you can see that as the risk of the loan goes up, the interest rate that the lender is willing to accept becomes higher and higher. Okay, that's pretty intuitive. And then this area below, which is sort of representing what would be acceptable to consumer, they basically have a constant level at which they would accept that interest rate, right? This is like, no matter what risk they present, they're willing to accept some interest rate up here, okay? But let's say in this particular case, this consumer has a predicted risk that is represented by this kind of dark dashed line. And the only region that the lender would be willing to loan to this consumer is at an interest rate all the way up here in the top right, okay? But the whole point is that this is not in the overlap of the terms that would be mutually agreeable to both the lender and the consumer. So if we were going to like explain this adverse decision, it might be with respect to this region over here. So essentially what the lender would say is like, we would lend to you if you make the following changes to get over here. But the terms that they would be offered in this region would not be terms that the consumer would be willing to accept. So instead, what you might think about is like, what is the region where there's actual agreement, and that you would want explanations with respect to the mutually agreeable region, right? But this is not actually what's happening because none of these things are actually taken into account. To go a bit further, as I was saying, counterfactual explanations are sort of these kind of instructions about how to go from this point, which might be on the wrong side of the boundary, to the right side of the boundary. And these regions here correspond to, so region 1, I, this region corresponds to what would be agreeable to the lender. And region II, this is the mutually agreeable region, okay? And if you know about counterfactual explanations, they basically say like, change the value of this feature by X, change the value of that feature by Y, okay? And you can imagine the following, right? Which says something like, you haven't been successful when you applied for a loan. So we're going to tell you, change the value of feature 2 by this amount so that you get to the region where we're willing to lend to you, which is here, okay? But again, because like that is not in the region that is mutually agreeable to the consumer, this explanation is actually unhelpful. And actually what's worse is that imagine maybe it's not that like, imagine in particular that the consumer thought like, well, okay, I'm not getting the terms I want by making a change of this magnitude. So maybe if I just make more of a change, a greater magnitude change in that same direction, then maybe I would get more favorable terms, right? So if feature 2 is like, let's say income, right? You might think like, well, I've been told to increase my income to get this loan. Maybe I have to increase my income even more to get more favorable terms. But depending on how the model is actually built, it could be that actually that's completely orthogonal to the direction that you actually want to go. So it may be that actually instead feature 1 might be something like length of employment. And it might be that it actually makes much more sense to go in this direction, because if you do go in this direction, it will actually be something that's mutually agreeable in terms. Okay. So all this just to say that, in the absence of considering differences in the utility that people might get from different terms, there might be a natural tendency to favor the welfare of lenders. I mean, practically speaking, right, like minimizing effort that is required to make changes probably is going to encourage a lender to focus on those things that require minimum qualifications, and those are likely to be the least favorable to consumers. So as I was saying, I think like explanations formulated in this way almost have this natural tendency to favor the interests of lenders over consumers. And this last point I'll make is that it's also possible to imagine that consumers just misunderstand the objective of the decision that's being explained to them. This kind of even comes back maybe to the point that Joseph was asking about. So I think consumers probably quite reasonably, in part because of the way this is presented to them, and maybe even because of the way regulators present it to them, might think that the explanation, the decision that's being explained is the decision about predicting default. But actually, minimizing consumer risk is not the same thing as maximizing lender profit. And the decision that's being explained is actually maximizing lender profit. So it's very easy to imagine something that says like, make these changes, you'll be a better candidate for credit in the future, and think that you're receiving essentially instructions about how to become better capable of managing debt, okay? But actually, that's not the case. It's just that they're trying to make you into someone who is going to be sufficiently profitable if they're willing to lend to you. And so you can make a bunch of the changes that you've been told to make, gain access to the loan, but unknowingly actually still present a really serious risk of default. And so I think this is like a real concern with this entire approach, that like consumers might be taking on way more risk than they realize because they're misunderstanding the decision that's being explained to them as one about making them better candidates for debt rather than actually making them better candidates for profit. Okay, so this is kind of like the main set of problems that Manish and I have been trying to think through, and we're now beginning to think about some directions to actually take this, some technical, some regulatory. I'll mention a few, but we would be very interested to hear your thoughts on what we presented. So, sorry, I don't know why this is so. Okay. So I think there are two quite different situations. Some of these are more straightforward than others. The law, as I mentioned at the start of the talk, requires that you get explanations even when you're offered a loan, so long as those terms are less favorable than those that you requested. So in cases where the consumer can actually specify the terms they want, maybe this is not that much of a problem because they're going to be getting explanations with respect to the specific terms they requested, right? So for some kinds of loans, like a mortgage, you often make that clear in advance. You say like, this is the interest rate I'm hoping to get, this is the amount of money I want, etc. That's not the case for some other kinds of lending, like credit cards. But even in the case where you're being explicit and you're able to articulate upfront the terms you want, it puts a lot of burden on the consumer to know what to request because the explanations will always be with respect to what has been requested, right? And so it's possible that maybe you undershoot the mark. Maybe you say like, I would like a interest rate of this amount, but in fact, like, 10% interest rate over some amount of time, when in fact, the lender would have actually been willing to loan to you at like a much lower interest rate, but you didn't think to ask that, right? You only asked with respect to this particular interest rate. And you could easily overshoot the mark, right? You might say like, I want these terms. And then it might be that the explanation you get is something like, we're not willing to lend to you on those terms under any circumstances. So there's a lot of burden that sort of is still placed on the consumer to figure out even how to articulate this. And then as I was saying, like with things like credit cards, where you actually don't even have the opportunity to kind of specify these things, the lender has full freedom to figure out what terms to default to. And when they do, it's very likely that they're going to default to terms that advance their interests, right? That are not going to be the most favorable to consumers. So the explanation that you're going to get is one that's advancing their interest, not yours. So from a regulatory perspective, you can think, well, what can we do about this? I think as I was saying, at worst, this situation allows for a lot of self-dealing. Like the lender gets to explain things in a way that advances its own interests. At best, it can maybe support something like beneficent paternalism, right? Like the lender knows that you shouldn't do something and is trying to keep you from doing something that's not in your interest. But in the absence of anything that sort of requires that lenders act a particular way, it's just really not clear what will happen. So interestingly, in a lot of these contexts, like in other relationships that consumers have with someone who has expert knowledge about, for example, finance, we have things like fiduciary responsibilities. So this is when like a decision maker might be able to give you advice that actually is in their interest rather than your own. And the consumer is not in a position to judge whether or not that's sound advice. And so in those cases, we impose fiduciary obligations as a way to compel, in this case, the lender to actually give you potentially an explanation that is in your interest, right? So one way of solving the problem that we're discussing here is to essentially mandate that the explanations are those that are actually in the interest of the consumer, not in the interest of the lender. And under those conditions, maybe it's actually a good thing that the lender is kind of given the burden of trying to figure that out, because most consumers will not know how to do that for themselves. Another thing you might think about is that a lot of the data we might use to predict default, so as I was, again, coming back to Joseph's question, a lot of the data that might be useful in this underwriting model, which is to predict default, could easily be used to try to also infer sensitivity to price, right? So how much is the consumer willing to tolerate in terms of interest rates? And one way we might try to deal with this is to sort of separate out the possible uses of this data. We might want the lender to do a really good job in estimating default, but we might want to restrict their ability to estimate how much consumers are willing to pay. And so we might impose rules that just sort of hamstring the lender's ability to make better judgments about willingness to pay, while we still want to make them better able to understand and manage risk. So this is, again, the kind of legal mechanism to maybe deal with some of these problems. And then I think from a technical perspective, there's actually just a bunch of open questions, which might seem like they're kind of narrowly focused to the domain of finance, but I think actually might be broader. So to begin with, we actually don't really have explanation techniques for decisions that are non-binary. If you look through the literature, pretty much everything is about binary outcomes. There are obviously like some things where there's continuous scores, and we might be able to like give some sense for how differences in scores are determined. But generally speaking, continuous scores almost always figure into binary outcomes in those, into binary decisions in those settings, right? So a credit score is actually a perfect example of this, right? A credit score is not a binary outcome, it's a score, and it's continuous or quasi-continuous, but it's used to make this kind of binary decision in the kind of formulation here. So from a technical perspective, I think there's a lot to be done thinking about what explanations would even look like when there are more than one possible outcome that we care about. And then going a step further, we might ask like, okay, if there are multiple outcomes and there might be differences in the preferences of those outcomes between the decision maker and the person subject to the decision, how do we design explanation techniques that actually are able to incorporate those differences and preferences? So, right, like there's been a tremendous amount of work recently trying to figure out how to move away from a naive way of generating counterfactual explanations to something like recourse meaning things that people are actually able to accomplish in practice. What action can I take to actually get the loan? But I think there's even more to be done here about differences in preferences over different actions and over different outcomes. So this, I think, too, is like an area where Manish and I are trying to begin to think a bit more technically as well. So I think I can stop there. I hope everyone was able to follow. And yeah, I'm very happy to take questions or have an open conversation now. So thanks very much. Yes, Alan.
Hi, thanks very much for a fascinating talk. Before I ask the question, I just want to make an observation about some of your points at the end about fiduciary responsibility. Australia has just had a multi-year scandal where a large number of investment and insurance companies were proven over and over again to be acting in ways that were against their fiduciary responsibilities. So simply legislating such responsibilities is a long way from doing any good for people. So that's just an observation. The question I had was, a lot of this setting you're in is one that's essentially assuming a very personalized approach to lending. So in other settings, for example, if you go for car insurance, the insurer has a bunch of situations. It's a very fixed thing. Anybody in this suburb with a car of this value is charged this amount. And how would you see it if we shifted from the lenders being able to tweak the rates they charge to essentially having a collection of packages, and they simply have to set up rules who is eligible for each package and then apply that to everybody?
Yeah, it's interesting. My impression is that, so I know nothing about the way that insurance pricing is regulated in Australia. I know a little bit about how it works in the US. In the US, notably, it's at the state level. There's no federal law that regulates insurance pricing. But it is actually quite variable. So one of the more important kind of actions that's been taken with respect to discrimination the past couple of years in the US has been with respect to differences in car insurance pricing. And there, again, it wasn't that it was like set according to some actually fair scheme. Instead, it was quite personalized, and it was understood to be, again, taking advantage of people's differences and willingness to pay. And so my sense is that what I've been describing here is not uncommon even in insurance markets in the US. But I don't know the degree to which that's true. I don't know if it's to the same degree, and I certainly don't know the degree to which that's true in Australia. So,
thank you.
Yeah, there's a Miriam, is that it?
Yes. Okay, basically I have two questions. The first one is that, we have different methods for explanations, and I can imagine that each method is more applicable for a specific application. But what I realize is that we have a general rule such as we should have explanations and users have the right to ask for explanations. But is that clear that what kind of explanation they should ask or what's their right? Because having the right for explanations is a too general term for me. For example, in the example of loan application, maybe users are more searching for like a counterfactual explanation rather than feature importance. And companies are more inclined to explain about counterfactual explanations. They don't want to like reveal their policies. But in a medical application, maybe doctors are more searching for feature importance rather than counterfactual explanations. So is that are rules specific that what kind of explanations we want for a specific application?
It's a great question, and I agree completely with your sentiment. So my view here is that there is like no universally good explanation. I mean, some colleagues of mine in the New York lab of Microsoft Research have written papers to kind of empirically demonstrate this. But I think, as you say, like depending on the setting, depending on who the explanation is for, and the purpose that you want the explanation, all this will vary. I think counterfactual explanations have been attractive for pretty much exactly the reasons you said in the context of credit. It seems to go away to some degree to protect the kind of intellectual property that they think they have in the model itself. And it's understood to sort of be aligned with what you imagine consumers want, which is not exactly to understand like how the model works in general, but instead what they can do to be successful in applying for a loan in the future. But my main concern with this is very similar to yours, which is that even if you agree that maybe in this context, counterfactual explanations seem more sensible, there's still a huge amount of latitude for what those explanations look like, right? We can have different constraints on the counterfactual explanation that encode a bunch of other requirements. And those will all still be correct in some sense. It's just not obvious like what ideally that would be. So I think a lot of these details really matter. Not in the work I presented today, but in a previous paper, I've done a lot of work thinking about like why it's actually very, very difficult to develop counterfactual explanations that are genuinely aligned with consumers' interests. And so I doubt regulators are ever going to be so specific that there's like some law that says use exactly this method in this way. But I think like there needs to be a lot more attention to the fact that, if we, different settings, different target of the explanation and the goal. And I think that's not really where the conversation is, even at this point.
Okay, thanks. I have another question too. For example, for the code of conduct about the communication between doctors and patients, when doctors want to communicate and explain something to patients, they should be respectful and honest. Now consider that we want to replace it with an XI system, and how we can like measure that how this XAI system is respectful or honest, or if it's not, who should be punished or things like that. Like, do we have any study to try these features in XAI or make up a definition for them?
That's a really interesting question. I actually don't know if there's an equivalent requirement in like the US, like ethics code for doctors, but it's fascinating. Like I don't know exactly like formally what it would mean to say that like this is an honest and respectful explanation. My sense is that like, as I was saying a moment ago, I think like there are many things that might be accurate, but they vary, right? Like you can explain an infinite number of ways you could change features to get to the other side of the boundary. Those are all accurate. Is that enough, right? Is it enough that like they're accurate? Was that like qualify as honest and respectful? I think probably not, right? I think like some of these things, like to the degree that you think it's actually helping, in this case, maybe the patient really understand the illness they face or the things they can do to manage their illness, like maybe that's not. The only area where I feel like some similar question has come up is in the US, there's been some interesting legal scholarship on robo-advisors. So robo-advisors are literally like when you replace like your financial advisor with an algorithm. And the question there is like, your financial advisor traditionally would have a fiduciary obligation to you. They would have to like give you advice that's in your interest. And people wanted to know, like, how do we know that the robo-advisor is actually giving you advice in your interest? So it's almost similar question. And I think people are still struggling with this. Like it's sort of hard to technically formulate things in a way that you would say that, yeah, this is sort of, in your case, respectful, or in this case, like clearly advancing the fiduciary interest of the, the interest of the fiduciary. So I think these are very interesting questions. Like I would like to see more work in this area, but I don't have an answer.
Okay, thank you so much.
I think Judy was next.
Hi, yeah. Thank you for your talk. I really enjoyed it. I'm just wondering about one other dimension in all this, and that is the noise in the decision making and the uncertainty in the decision. And obviously, I mean, it's great you've moved beyond binary, but and I know this is opening. I'm very influenced. I've just got looking at this book by Kahneman, Sevigny and Sunstein called Noise, which you've probably seen, and it actually is very much about this domain as well as others. And I guess decision making is a noisy process for humans and for machines, but machines theoretically could at least quantify their confidence in the recommendation. And obviously in the context of the stuff you're talking about, you could imagine even a policy that is applied would have a confidence in how useful it is, both for the benefits of the customer and also for the benefits of the company, trying to maximize profit on all the various dimensions. And I suppose it doesn't help to say things are so noisy we have no idea what they mean, but I just wonder if that's part of the story, part of the explanation to say something about the confidence, if that makes sense.
It does make sense. It's a great question. I mean, you can imagine like something which is like, let's for the moment assume that like actually the explanation is about the prediction of default. You could imagine a requirement that says something like, you also need to report like your confidence in that prediction, right? Or the degree of uncertainty, and it needs to be quantified in some way. And so when someone receives this and they're being given advice, you might say like, okay, we think that if you make these following changes, we'll lend to you in the future, and we think that you will not default. But if that's a very low confidence thing, it's probably important for the consumer to know that, right? So you're directing them to take some action, but maybe like, you know, your ability to predict that is extremely low. So I could imagine that being integrated into some of this. But I haven't seen anything along those lines, so it would be interesting.
And I guess just one other follow-up, and that is that in human learning, metacognitive skills, in particular, the skill of being aware of your confidence is one of, I mean, there are about 40, right? But it is an important attribute of effective learning, and I suppose, messy word, human intelligence, messy term. I'm not aware that there's been much, well, that link has been drawn either, and I don't know if it's interesting for your work.
So there is a part of this that Manish and I have been talking about that I don't think is really reflected here. I'm very interested in, which is that a lot of the work that's been done on explanation sort of assumes that the person who's applying for a loan like knows quite well whether or not they would actually be equipped to take on that debt. But actually, like my sense is like consumers are terrible at this, right? Like they have a really bad sense of if they're going to default, what terms are going to be acceptable to them in the long term. And for that reason, I've often thought like, why is it that consumers don't perceive adverse decisions from lenders as essentially like advice? Like, yep, like, we know you want this, but like, we know better than you. This is a bad idea. Don't do this. Instead, I think it's always perceived as like, no, the consumer knows exactly what to do. They just need to be able to like do the thing they want to do. And it would be, I think, much more interesting to kind of begin to imagine like, how do we develop a way of providing explanations to consumers or even sort of interacting with them where it's possible for the lender to communicate that they actually know things that the consumer doesn't and is in fact trying to like perhaps to some degree look after their interests. And so it's not just, you know, we don't like you or we're trying to exploit you or whatever. It's like, you're not in a good position to judge this for yourself. And we're going to give you some sense for why that's the case. And I would like to see much more work in that direction. And that's, yeah, so that's one area that Manish and I are trying to think more about too.
Thank you.
Thanks. I lost track here. I think Ty might be next.
Hi, can you hear me?
Yes.
Hi, it's a great talk. Thank you. On the current slide, you mentioned that there are a few explanation techniques for decision that are non-binary. And I find that really interesting because like what's the difficulties lies between a binary decision and a non-binary decision when you can do continuous scores? Can you use the loan granting example to maybe explain a little bit like what makes the non-binary decision like more difficult for the explanation techniques?
Yeah, so I think in this case, what we were imagining is like, imagine a space which is sort of like all the different terms that might vary. So like interest rates and down payments and the schedule upon which you're going to repay a loan. You can think of these as all being different dimensions. And if I go back, let's see if I can go all the way back, right? Yeah, so you can imagine this is a 2 dimensions, right? But like you can imagine this is multidimensional and like there's just some parts of the space where there's actually like overlapping, like there was agreement that this is actually acceptable set of terms. So if, like, you're in some point in the space, and maybe you want to get to this here, it's like you might want to figure out like how to travel there. But I think this is in the space of terms. The explanations are being offered in the space of features. That makes sense, right? So like I'm saying, change the value of these features and so on, right? So like there's an interesting question about how to like do a mapping between like differences in the terms that people might want to like the actual actions that people are going to have to take with features. And the really difficult part is that like we often don't know, we often don't know this, okay? Like we need a way to like encode a lot of these preferences into the information that is being used to generate the explanation. When in fact, we don't really have access to, generally speaking, we don't really know what consumers, preferences are. So this becomes also like a second problem. Does that make sense?
Oh, okay. Yeah, kind of. Do you know where I can maybe read more about this? Yeah, I really want to think about this question. It's interesting.
Yeah, I mean, it's just, my impression is that there really isn't, like Manish and I have not found any work that tries to do this. I think like the closest thing that maybe we come across is that there's been some work done on recidivism prediction. So this is like where in criminal justice, someone has been arrested, but they haven't yet been seen in court. And the decision is whether to release them pending their trial. And and so in those cases, the model actually outputs a score most of the time. And that score is then mapped onto different thresholds. So it's like high risk, medium risk, low risk. So it's not binary, right? There's like at least some differentiation. And I think people have been trying to develop explanations for that. So there's just some degree of like, it's a step beyond non-binary. But that's like the only thing that we really have seen. Otherwise, it tends to be very much focused on these kind of binary outcomes.
Sure, thank you.
Thanks. Joseph, I apologize if I overlooked you. I don't know if you were in the queue. Yeah.
No,
okay,
I hope there's time. If there isn't, I can talk to you separately. But is there time, Kanchana?
The meeting was scheduled until 11 a.m. So there are, many people left by now. But I think we can continue the discussion if people are interested.
I'll keep it short. Again, thanks for a very interesting presentation and research, which opens up the whole area of explanations, which was long overdue, as you rightly showed in your presentation. My question is there a need to look at it even more broadly in terms of what economists would call information asymmetry? Because you're dealing with a highly asymmetric situation in terms of knowledge, information, data, everything else. And then you have these algorithms which perform something which people most of the time don't understand. For a while, we thought it was just protected variables and you could take care of that. That got us somewhere, but not very far. Now explanations, and clearly we are seeing in a lot of situations, they don't really go enough. So is there a need to look at it in a broader information asymmetry kind of context to understand the dimensions of asymmetry and then sort of try to package the explanations? And we may do it in a case-by-case basis. But is there a need to look at it in that kind of broader context?
Yeah, I really like your question, Joseph. So like one of the things the slide I left off was this slide, which is trying to get at this. So I think in a way, like the conversation happening within computer science is almost overloaded explanation, right? It's like explanation is the mechanism that's supposed to achieve a bunch of different goals, right? Like reveal discrimination, help consumers achieve better outcomes, et cetera. And I think we need to probably at some point step back, like you're saying, and ask, are there like other mechanisms besides explanation that actually are better suited for this task? So one thing that certainly has occurred to me is like, why are we doing this all after the fact with explanations? Like maybe the whole point is to directly address, like you're saying, these information asymmetries at the stage that people are contemplating applying for the loan. So in the US, we have lots of requirements, legal requirements for disclosure upfront. But it's weird because again, like the at least the technical community has just been exclusively focused on what to do with explanations. And you might think like, well, maybe we should be doing a lot more to help communicate things at the outset. Maybe even some of the techniques that were sort of focused on explanations could be useful actually even before some adverse event. And so I think this is the right question, right? Like if the real issue here is how like lenders can exploit information asymmetries to their advantage, what other things should we be doing beyond explanations to help tackle that problem?
That's right. Yeah. Thanks very much.
Thank you.
Yeah, I hope to be in touch.
Yeah, I'd love to. And Miriam, I don't know if that's your hand from before or you wanted to ask another question.
I think she's done.
Yeah, I think probably she left her hand up.
Okay.
So may I? No, I kept my question at the last.
I don't have any question. I just it was just mistake. Sorry.
Okay. No worries.
This is not exactly related to financial, like, these kind of credit explanations, but it's quite similar to counterfactual explanations in online privacy domain, since you're working on explanations. For example, so, you tried to provide explanations for adverse outcomes, but not just for adverse outcomes. Let's say I'm sharing some of my data, but I want to preserve my gender. So I might not share my gender, but in today's context, it's not so obvious. So even though I don't share my gender, with some other feature combination, the machine learning model can infer my gender. So same goes with, for example, location. Okay, even though I don't share my GPS, so the model can still figure out where I am. So have you done any work, or have you seen any work that in this case, not just lenders, service providers are willing to provide explanations to the consumers? Okay, if you want to preserve gender, this is what you want to hide or not sharing with us.
Yeah, actually, this is a great question. So this is your question is very closely related to some other thread of work I've been doing on privacy, and specifically like what machine learning does to privacy, which is exactly what you're saying. You can infer a lot of these things. There's one specific paper, which I can actually maybe try to dig up and put in the chat, or I can email it to you afterwards, which did exactly this. So I don't know if you're familiar with this study from many years ago that was in the Proceedings of the National Academies of Science, PNAS, that was using like Facebook likes to infer a bunch of different things about people, like including their gender and what have you. So like it was a sort of proof of concept that using information that on its face didn't seem to be very revealing could be sufficient basis to make inferences about a bunch of much more sensitive things. And the paper that I have in mind, they actually wrote to the authors of the original study, got the data, and then were able to kind of use some methods to figure out like what would have to be withheld to impede those inferences. Like specifically like what you're asking, like here are the specific things you would remove from your profile in order to make the inference about gender much more difficult. So it's actually an empirical paper and they show a bunch of results. It's very interesting. I have to say that like that is very, very case specific, right? So like that could obviously change as like more training data comes in, as more users like join the network. Like it's the snapshot in time. And so that strategy might work if the model is completely static and we do nothing else. But as I'm sure you know, like in many of these settings, like retraining is common. And so I really don't imagine that like this would be a strategy that's particularly robust to the natural way that like production systems actually work. Like I might withhold something now, but like, a year from now, Facebook, for example, will have retrained and they'll now be able to infer that despite the fact that I've withheld this thing. So it's like a kind of whack-a-mole problem, I think. But if that's interested you, I can find this paper.
Thanks, Solon.